What I'm about to share could completely change how you view the precious metals market right now. Gold is approaching $5,000 per ounce. Silver is knocking on $100. And the consensus opinion says the move is over. Time to take profits. The rally has gone too far. But well-known precious metals experts Peter Schiff and Andy Scheckman are saying something completely different. They're arguing the biggest gains haven't happened yet, that right now, at these elevated prices, might actually be the last chance to position yourself before something much larger unfolds. Stay with me, because what they're revealing about mining stocks, global monetary shifts, and the quiet repositioning happening at major banks will completely reframe how you understand what's happening in these markets. Before we dive in, smash that like button, drop your thoughts in the comments about where you think gold is headed, and subscribe so you don't miss critical updates as this situation develops. Right now, gold is trading around $4,760 per ounce. Many investors see that number and assume the opportunity has passed. Schiff and Scheckman couldn't disagree more. They're projecting gold could reach $10,000 per ounce. Even $20,000. These aren't speculative predictions designed to generate excitement. They're mathematical projections based on currency debasement, expanding debt levels, and the long-term erosion of dollar purchasing power. From their perspective, higher gold prices aren't excess speculation. They're the natural consequence of policy decisions. When governments choose dilution over discipline, when debt expands faster than productive capacity, when currency creation accelerates without corresponding real economic growth, gold doesn't rise because of hype. It rises because it's measuring the declining value of everything priced against it. James Rickards has publicly stated he believes gold could reach $24,000. Is that realistic? Will it happen? Nobody can predict exact numbers with certainty, but the framework makes sense. If you need to devalue currency to restore balance in an over-leveraged system, gold's price in that currency must rise proportionally. That's not conspiracy theory. That's mathematics. Silver and mining stocks are positioned to leverage this trend even more dramatically than gold itself. As investor participation accelerates, as more capital rotates into tangible assets, companies producing these metals could see exponential gains. The message from these experts is clear. Those who hesitate now, those who assume the move is finished, may look back with serious regret as this repricing continues. But here's where things get really interesting, and this is information most people aren't paying attention to. Stay with me, because what's happening at the banking level reveals how fundamentally different this situation is from previous cycles. Recent reports from the Economic Times suggest something remarkable. JP Morgan allegedly reversed a massive 200 million ounce short position in silver, not only covered it, but went long. They reportedly purchased 21 million ounces of physical silver over just 6 weeks. If accurate, this represents a complete strategic flip by one of the largest players in precious metals markets. Even more significant, the report suggests major US banks, the Big Five, are now predominantly long silver. That leaves 1 or 2 banks in other regions, plus a couple European institutions, massively short as prices climb. This creates an entirely different dynamic than 2011. Back then, the short squeeze was about technical positioning. Now it's about national sovereignty. Look at what's happening with the BRICS nations and the Enbridge system. They're using gold to settle trade imbalances and currency exchanges. Instead of converting everything through dollars and treasuries, they're trading digital yuan with countries like Saudi Arabia, receiving oil, and that digital yuan is immediately convertible into gold off the Shanghai Gold Exchange in Hong Kong without ever touching dollars. Guess where the second exchange is being built? Saudi Arabia. They're planning multi-jurisdictional vaults throughout the Belt and Road, creating a system where countries trade in local currencies and settle balances in gold. Gold is being integrated into the global monetary system, and silver is being recognized as flat-out critical for an advanced technological world. This isn't a secret anymore to those pulling the strings. Countries with sufficient wealth and sophistication are challenging the hegemony that depended on nobody standing for physical delivery. And that challenge is happening right now. Recent market action confirms this shift. Gold was up approximately $160 since the previous Friday, closing near $4,758. That's a 3.5% move. Silver performed even better, up 4.5%, closing above $94 and trading above $95.5 during the day. That's a new record high. Silver was closer to $100 than to $90. Foreign stock markets in US dollar terms performed well. European names were mixed, but emerging market stocks in Southeast Asia and South America showed serious strength. It was a strong day if you owned overseas equities, precious metals, mining stocks, or emerging markets. It was terrible if you owned US stocks. Even worse if you owned Bitcoin, which tanked harder than equities. Bitcoin dropped back below 90,000, trading around 89,600 after being near 95,000 the previous week. Interestingly, Michael Saylor announced Strategy purchased over $2 billion worth of additional Bitcoin. His average price was over 95,000. He's already down over 100 million on that purchase. Some believe his buying created the high he bought into. If this analysis is helping you understand the bigger picture, make sure you hit that like button and subscribe with notifications enabled, because what I'm about to explain about mining stocks could be the most important part. The precious metals landscape looks fundamentally different from previous cycles. This isn't just about market speculation. It's about global sovereignty, monetary reset, and the deliberate embedding of physical metal into international commerce systems. Digital currencies tied to real gold convertibility are reducing dollar and treasury reliance altogether. Capital appears to be rotating deliberately toward tangible assets and away from financial abstractions. This divergence across asset classes reinforces that something structural is shifting, not just cyclical trading patterns. Now let's talk about mining stocks, because recent price action reveals something fascinating. Even on days when gold and silver prices pulled back, gold down $20 to $30, silver down a couple dollars, mining stocks rallied. Both gold and silver mining equities moved higher, while the underlying metals declined. This unusual divergence often appears early in powerful rallies. According to Schiff, investors are recognizing that many gold and silver stocks remain deeply undervalued regardless of short-term metal price fluctuations. Schiff's message is direct. There's tremendous upside potential in these stocks from current levels. He believes that at year's end, people who didn't buy gold and silver stocks at these prices will be kicking themselves. Gold will be very expensive. Right now it's approaching 5,000. It could reach 10,000, 20,000. Even though gold and silver have already moved up substantially, they're not going to stop rising. The fundamental drivers, currency debasement, debt expansion, monetary system restructuring, aren't reversing, they're accelerating. Stay informed, stay focused, and pay attention to what's happening beneath the surface, not just the headlines.